the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua, Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as usual, a quick recap of some key movements. While Singapore shares moved higher today as investors continue to set their sights on corporate earnings out of the country. So if we look at the Straits Times Index, it was up 0.49% at 4,217 points at about 2:06 p.m. Singapore time, and that is with a value turnover of some 761 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. The STI ended up 0.27% at 4,208 points. In terms of value turnover, that's 1.41 billion Sing dollars. Now, gainers outnumbered losers 297 versus 218. Top advances for today, we've got for you DBS, iFast and SGX, and top decliners, we've got here GMH USD, Jardine Cycle and Carriage, and New Incorporation USD. Now, in terms of counters to watch, we have CapitaLand Ascendas Reit because the industrial property player posted a 0.6% drop in DPU for the first half of the 2025 financial year, down to about 7.47 Singapore cents on the back of an enlarged base. Now, elsewhere from Singapore's retail sales growing 2.3% year-on-year in June to gold prices rising on the back of a weaker US dollar following softer than expected US jobs data. We've got more economic headlines in focus. And joining me right here in the studio is James Cheo, CIO Southeast Asia and India at HSBC, Global Private Banking and Wealth. James, welcome to the studio today.
Well, glad to be here.
Great to have you. And James, let's start with, the Singapore stock market as usual. How did the STI fare today? And any surprises when it comes down to the biggest movers and, of course, the sectors that they lie in?
Yeah, well, I think a lot of the movements were very much dependent on what had happened in the US overnight. So generally, there was a sort of kind of an increase in risk appetite, especially in the US, and somehow that trickled into the Singapore market. But clearly, I think there are a lot of nuances in terms of earnings report, especially in Singapore. So I would say the story is very much backed by individual companies' earnings report, as well as I think on a sector basis, it seemed like a lot of the financials within Singapore has been fairly well supported.
And James, let's zoom in on some of the counters to watch for today. Earlier, we talked about CapitaLand Ascendas Reit. It posted a 0.6% drop in DPU for the first half of its financial year 2025, down to 7.477 Singapore cents. And this is on the back of an enlarged unit base. I know you don't comment on individual firms, but beyond CapitaLand Ascendas Reit, there are other REITs reporting as well. Among them, CapitaLand Integrated Commercial Trust, Land Lease Global Commercial REIT, Frasers Hospitality Trust. Now, all in, how are the REITs faring in general then?
Yeah, well, I have some comments on the sector as a whole. I think what we are witnessing right now is that there are some tailwinds for REITs as a whole, really, because on the back of falling interest rates, especially one that's driven out of the US. Right now, in terms of the probability of rate cuts in September for the US has increased, and that has a kind of a trickle-down effect on Singapore REITs, given that US rates are falling as well as capital is flowing into Singapore. That's bringing down Singapore interest rates as well. So REITs as a whole, I think, face that tailwind. But of course, the story is very much nuanced, but even within the REIT sector. So areas like retail or even hospitality, I think that there are some pressure regarding upgrades of assets, etc. But I think generally industrials, warehousing, data centers, I think still look fairly resilient.
And if we could stay in Singapore, James, retail sales that grew 2.3% year-on-year in June. On the back of broad-based increases across industries. So the reading was also above the median estimate of 2% growth from private sector economists polled by Bloomberg. How would you read into the latest numbers, and really what does it say about the outlook of Singapore-based consumer-focused firms?
Yeah, well, I think as a whole, if you look at consumer spending, I think that's an encouraging number. I think that's really on the back of many things, right? I think generally the labour market's still very healthy, unemployment extremely low. And I think people are just out, spending in that sense. But I think having said that, if you look deeper, there might be segments of the economy that actually are facing some pressure. I mean, we were talking a little bit about REITs, and one of the models they have to increase DPU for shareholders. So that means rental. It's of course an issue for some of the smaller businesses. So I think those issues would start to slowly permeate through the Singapore economy.
Okay. Now, across the region, James, let's talk about what's going on in China and also the U.S. We're seeing a record number of Chinese companies seeking a U.S. listing this year because onerous domestic listing rules and the prospect of better valuations convinced them to brave Sino-U.S. relations, as well as U.S. calls for strict oversight of Chinese firms. So just to bring up some numbers, law firm K&L Gates said in a Reuters report that 36 mostly small and mid-sized Chinese companies went public in the U.S. in the first half of 2025. After a record year in 2024, what do you make of the news? What opportunities and risks does this present for investors?
Yeah, well, I think this development of Chinese firms going to U.S. and raise capital, I think that's encouraging given what's happening on a global stage. For companies that are going to U.S. to raise capital, I think there are various reasons. I think one of the reasons is that they believe that their investor base is in the U.S. and also the business model is something that the U.S. investors understand. And of course, there are lots of it's the entire ecosystem in the U.S. that's supportive of these Chinese companies. So I think at this point of time, this increase in activity by these small and medium companies raising capital there is something that's encouraging. And of course, if you do get more cross-border fertilization of ideas, of capital, it's always positive for the world economy.
And in the meantime, James, let's talk about India. The HSBC India Services PMI, compiled by S&P Global, that should grow in India's services sector accelerated to an 11-month high in July, driven by strong international demand and sustained domestic sales. Question then, how far can that growth momentum be sustained given the ongoing tariff situation with the US and the shifts in global supply chain?
Yeah, well, if you break down India's economy, the services side of things is extremely resilient because a lot of the services that are outsourced are going into India. So they have global capability centers that provide services that are not just call centers. It's in fact R&D, engineering services, accounting, legal services. So India is actually benefiting quite a bit from those GCCs, if you will. But more than that, also the economic momentum in India is starting to kind of pick up. A year ago, it slowed down really because the rural economy experienced bad weather. So farmers had less crop to sell. This time round, the weather is better. The farmers had a better harvest, so they can sell more of their crops and they are making more money, and rural consumption is increasing. So I think from that perspective, there are signs that there is some pickup in the domestic economy, and a lot of that has to do with the services side of things.
And further away, James, let's talk about gold. Gold prices rose today after gaining in the last 3 sessions. Now, that is supported by a weaker US dollar, lower treasury yields, and the culprit, if you will, is the weaker than expected U.S. non-farm payrolls report, fueling cuts of interest rate by the Fed in September. So what are the levels to watch for the yellow metal, in your opinion?
Yeah, I think gold is a very interesting asset class because it provides a sort of a portfolio diversification. And I think that the point is that we are at a time where interest rates are going to go lower really because of the realization last Friday that the job market in the US is not as strong as initially everyone thought. So I think interest rate cuts are very much on the table in September, and that's why with a falling interest rate environment, a weaker dollar, investors want to be in gold, because if you do get slower growth, and of course with political and geopolitical uncertainty, gold is an asset class to provide that hedge.
Any numbers to watch, levels to watch, if you will?
I would say that at this point, it looks like it's supported, very much range bound. But if you do get a certain, kind of impetus, if you do get weaker economic data in the weeks and months ahead, especially on the labour front, that might spur more buying into gold, and that could actually provide a lift up for gold in the weeks and months ahead.
All right, thanks so much for the insights, James. That was James Cheo, CIO Southeast Asia and India at HSBC Global Private Banking and Wealth. Thank you so much for joining us today.
Oh, pleasure is mine.
Thank you.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.